Well, after the historic move by the Bank of Japan yesterday to raise interest rates for the first time in 17 years and to make rates positive for the first time there in 7 years, its currency promptly collapsed against most others. The Australian dollar this afternoon, you can see it here, sitting at 98.91 Japanese yen. That's the highest point against the yen in more than 9 years. You've got to go back to December 2014 to see it at this rate, close to 99 yen to the dollar. Against the euro, the yen is the lowest in 16 years. It certainly makes a visit to Japan cheaper, and it raises questions about whether, with some growth emerging, that whether now is a good time for Australians to buy assets there. And the US Federal Reserve will make a rates decision overnight our time. Broadly, it's expected to be on hold with a press conference by Fed Chair Jerome Powell tomorrow morning our time. But with all this, Ed today spoke with Paul Sheard, a noted Japan expert who's the former Executive Managing Director and Global Chief Economist with Standard & Poor's and the author of the best-selling book, The Power of Money.
Well, Ed, it's actually a very big moment. This is not just the Bank of Japan making a tweaking or adjustment in its policy rate, but it's actually a change in the whole framework. The framework up until now, which was started under Governor Kuroda back in 2016, was called quantitative and qualitative easing under yield curve control. And it had a number of elements in it. Key ones being the overnight interest rate being at minus 10 basis points, but importantly, the long-term or 10-year JGB rate being pegged around 0%. They let that drift up to a ceiling of about 1%, but they were doing this yield curve control, something that the Reserve Bank of Australia kind of copied from the Bank of Japan. But there were some other elements in there, buying equities and also REITs, J-REITs, the real estate investment trust. So it was a whole package, and now the Bank of Japan has made a really important judgment, and the judgment is that the mission accomplished, that the Bank of Japan now feels sufficiently confident that a positive cycle of wage growth feeding into inflation has been established, and now they can start to change their framework and move back to something that is more like a normal monetary policy framework. Bear in mind here that while the rest of the world has been struggling with inflation, high inflation after COVID, for Japan and the Bank of Japan, it's been a welcome development because they've been spending best part of 20 years trying to get out of mild chronic deflation.
Yeah, there's been a lot of speculation in the months leading up to this decision that it was going to happen. But what do you think was the trigger point that finally caused the BOJ to move?
The sort of accumulating evidence that they really looked at was the so-called Shunto, or the spring offensive, this round of annual wage bargaining that goes on that kind of sets the wage picture for the rest of the year. And that's been going on the last few weeks. And what the Bank of Japan and the government have both been saying to corporate Japan is, look, we've got above target inflation at the moment. We want that to continue, at least come down to 2%. That's a welcome development, but it can only happen if the corporate world starts paying wages commensurate with inflation running around 2%. So there's been a lot of focus, Ed, on how are these numbers coming in? What are the big companies paying? And the headline numbers have been coming in at above 5%. And so the Bank of Japan has made the judgment that now is sufficient confidence that it can make this move. The timing, though, is a little bit odd in the sense that if they'd waited until April, that's when they have their major inflation report, so-called outlook report, and that's when they tweak their forecasts, and also would have given them an extra month to observe whether these spring wage negotiations were really coming through as they expected. Still in progress. And so they were a little bit early. A lot of people had expected they would make a tweak on the negative interest rate. But I think what surprised me, and I think some observers, was that they went the whole hog and they've just got rid of the whole framework. Now, having said that, they're still being quite accommodative with monetary policy, not just with a very low interest rate, but also continuing to buy government bonds in pretty large amounts.
And Paul, can you just explain for our viewers why the Japanese economy is in such a different place to other economies around the world, like Australia, the UK and the United States?
Yeah, that's a very good question, Ed. It's probably a long story, but to cut a long story short, after the banking crisis or during the banking crisis of the 1990s, which followed the bursting of the great asset price bubble of the 1980s, so we're going back decades in time here. But in the 1990s, Japan fell into mild deflation because of these very strong deflationary forces that were going through the economy because of the unwinding of the bubble and the deleveraging that took place right across the economy. Once inflation turns to deflation and the public gets used to that, and they actually expect mild deflation to continue, it's very difficult for central banks to overturn that, particularly just with monetary policy. And that's the situation that Japan slipped into. And, it's kind of continued for 20, 25 years. But, Japan, as I said, is really the only economy probably in the world where this COVID-induced inflation shock has been welcome, not in eating away at wealth, but rather in at least giving the Bank of Japan a good opportunity to now rein in inflation and retarget or re-anchor inflation and the public's inflation expectations around 2%. So it's very much an inflation expectations management challenge that the Bank of Japan has had.
So where does the Bank of Japan go from here? Are you now expecting rates to remain where they are for a long period of time, or could we potentially see more movements in interest rates in the coming months ahead?
It's certainly possible, but if the Bank of Japan does follow up with more interest rate hikes, it will be, I think, very, very gradual and quite modest, unless something unusual happens in the economy. But so it's more about, in some sense, normalization of the framework. The question of what do you now do with that framework? Do you start to hike interest rates aggressively? I don't think that the Bank of Japan would see sufficient evidence that inflation was coming back as a problem rather than as a solution to deflation.
And Paul, at the same time, the Nikkei stock market has been at record highs. What's attracting global investors to the Japanese markets right now?
Yes, that's a good observation, Ed, because for long-term Japan watchers, this has been quite historic the last few weeks, because the Nikkei, the main index, Nikkei 225 that people track, managed to get back to its previous all-time high, which was the very last trading day of the 1980s. It's taken Japan literally decades to get back to that point. So it's historic in that sense. There has been evidence mounting that the Japanese economy is undergoing a kind of macroeconomic regime shift out of this chronic deflation back into a deflationary kind of world. So nominal GDP in particular has been running ahead of real GDP. That's the normal situation, but it's been unusual for Japan. So when nominal GDP is growing faster, that's good for nominal variables in the economy, corporate profits, also the stock market. And of course, the weaker yen, which has weakened dramatically in the last year and a half, is really giving a spur and a stimulus to the export sector. And so I think global investors are taking a second look at Japan. And I think this move from the Bank of Japan underscoring the fact that something seems to be afoot in Japan coming out of those so-called lost decades, maybe piquing people's interest.
Well, Paul Sheard, economist and former vice chair of S&P Global, thanks for coming on the program today.